To keep most of your hard-earned income in your pocket, you need to understand tax credits and deductions. Unfortunately, these two terms are quite confusing to most, which makes it hard to get the maximum benefits that they offer. But once you know what each one means, you can confidently use them to reduce your individual or business tax bill as much as legally possible. So what causes the confusion? What exactly do the two tax terms mean? More importantly, what advantages can you get from each? The whole confusion around tax credits and deductions lies in the fact that both of them are used to reduce the amount of tax you owe to the IRS. So it's easy to see them as the same thing, which is why some people mistakenly use the terms interchangeably. However, while they both reduce your tax burden, they do so quite differently. So let's quickly define what each term means. A tax deduction is an amount of money that you can deduct from your total taxable income. This reduces the final income that is subject to taxation by the IRS. In most cases, these deductions are expenses that you've incurred throughout the tax year that the government permits you to subtract from your gross income. Now, you're likely familiar with the standard deduction, which is a specific figure you're allowed to deduct from your taxable income. As of 2024, this is $14,600 for single filers or married filing, but separately it's $29,200 for those who are married and filing jointly. However, not many people know that there are several other deductions you can claim depending on your situation and reduce your tax bill even further. Some of the most common ones include property taxes, sales taxes, or state income taxes. You can only choose one. IRA contributions. Keep in mind that we're only talking about traditional IRA. Contributions to a Roth IRA are not tax deductible. You have self-employed retirement plans like SEP, Simple, and Solo 401ks. Home mortgage interest. You also have health insurance premiums as well as health savings account contributions. And also you have your medical as well as dental expenses that exceed 7.5% of your gross adjusted income. However, keep in mind that this is an itemized deduction, which means if you claim it, you can't claim standard deduction as well. Also, you have alimony payments, charitable donations, and business deductions. The list is lengthy, and all this includes rent, wages, supplies, utilities, travel, business vans and trucks, insurance, repairs and maintenance, depreciation, licenses, operational losses, so on and so on. That said, tax deductions effectively reduce the tax you pay to the government in two ways. One is by reducing the income subject to tax, and the other one is potentially lowering your tax rate. On the other hand, a tax credit is a dollar for dollar deduction on your final tax bill. In other words, a tax credit reduces your tax bill directly. So whereas you subtract the tax deduction from your taxable income, a tax credit is deducted directly from the tax you owe to the government. That said, tax credits aren't for everyone, and eligibility depends on a numerous amount of factors from your age, income level, whether or not you have children, if you're paying for higher education, just to name a few. The most common tax credits you'll come across include the Earned Income Tax Credit, Child Tax Credit, and American Opportunity Tax Credit. Still sound a little confusing? Let's put everything into context by taking the example of James, an employed professional earning a gross annual salary of $200,000. His tax bracket, according to the 2024 federal tax rates, would be 32%. Assuming his total deductions from things like retirement contributions, mortgage interest, and medical expenses total to $20,000, his taxable income would be $180,000. That is $200,000 minus the $20,000 in deductions. The new figure would mean two things. One, his taxes will be calculated on the $180,000 instead of the total earnings of $200,000. And two, his tax bracket would drop significantly from 32% to 24%. Now let's do the math. Keep in mind that the U.S. tax system is a progressive one, which means that even though James is in the 24% tax bracket, not all of his income will be taxed at 24%. The first $11,600 of his salary will be charged a 10% tax. The next $35,550 will be taxed at a 12% rate, and the subsequent $53,000 will be taxed at 22%, which is $11,742. The remaining $79,000 will be taxed at a 24% rate as well. When you add these up, his total tax bill comes to $36,242.50. Without the tax deductions though, he would have paid $41,686. That means that the tax deduction has saved him an incredible $5,444. Now let's say he is eligible for a tax credit of $5,000. Rather than deducting this from his $200,000 gross income, he would deduct it from his tax bill. Let's say we use his tax bill without deductions, which is $41,686 minus the $5,000. His new bill has gone down to $36,686. That said, you're probably also wondering, which is better, tax credits or tax deductions? If you're offered a $20,000 tax deduction or a $20,000 tax credit, the obvious choice if you want to save the most money is the $20,000 tax credit. As we already learned, the tax deduction isn't directly reducing your tax bill, rather it reduces the amount that will be taxed. In our example of James, we saw that the $20,000 tax credit saved him just over $5,000 in actual taxes. However, if the $20,000 was a tax credit, he would have saved $20,000 from the tax bill, which means he would have just paid $21,686 to the government. Tax credits can be refundable or non-refundable. If a tax credit is refundable, then that means that if your current tax bill is less than the tax credit, you can claim a refund of the balance from the IRS. For example, let's just say you qualify for a tax credit of $5,000. However, your tax bill for that year is $3,000. That means there is a surplus of $2,000, which you can claim as a refund. Conversely, if a tax credit is non-refundable, you can only claim up to your current tax bill. Using the same examples, you can only claim up to $3,000 since this is your tax bill and consequently lose the $2,000. Unfortunately, most tax credits are non-refundable or partially refundable, except for the Earned Income Tax Credit, also known as EITC, and Premium Tax Credit for health insurance. So if your tax liability is pretty low, you won't enjoy the full benefit of your tax credits. On the other hand, certain deductions like depreciation in capital and or business losses can be carried forward to offset your income in the future years. So if you made losses in, let's say, the first 2 years of running your small business, and in the third year you make some profit, you can deduct these past losses up to 80% of your current year's income and save big on your taxes. The beauty of it all is that you can use both tax deductions and tax credits to reduce your tax bill. And that's right, the good news is that you don't have to choose one. You can actually use tax deductions to reduce your taxable income, and then once you have calculated your tax bill, use tax credits to reduce your obligation even further, dollar for dollar. For instance, you can claim the standard deduction as well as the child tax credit for each child you have below 17. The trick is to know how to maximize both to get the most tax savings. So a quick recap, both tax deductions and tax credits offer tax relief. However, they do so differently. While a tax deduction is deducted from your taxable income, a tax credit is subtracted from the tax amount after everything has been calculated. Combining both rather than choosing one over the other is the best way to reduce your taxable liability. However, remember that you may not qualify for all tax deductions and tax credits, so you want to look through what you can use to your advantage. Alternatively, you can ask your tax professional for advice on how to maximize these tax reliefs.